Hello traders, this is Rich Derrick from Tradesight. This is the market preview for this coming session. This is going to be for Tuesday, April 16th, 2013. We had a very nasty session where pretty much everything got hit fairly hard. The commodities leading everything lower, specifically gold and silver, really taking an absolute drubbing today. Margin selling and just an acceleration of the downtrend. Perhaps a climax, but we'll take a look at the charts later. What that led to was really just bids in general and the market being pulled. We had the S&P futures down about 38 or 39, and the Nasdaq futures were down 62. The Dow was down 250, which always gets a headline, but the real damage was what really happened internally, and we'll take a look at that in just a little while. But first, let's take a look at our multi-sector daily chart to see how everything played out as far as relative strength goes. So here's a look at our multi-sector daily chart. What you can see is there was just there was no place to hide today. There was selling across the board. You can see how sharply the XAU, which is the gold line here, got hit, and everything else turned down. The growth stocks, the defensive stocks, everything went down. The only place to hide today was in the fixed income market. Well, let's move on to the ES and the NQ charts. All right, here's a look at the ES daily. You can see the big range that we covered to the downside. We closed pretty much at the low after sweeping out to new nominal highs here late last week. Had this down day with this little doji candle, went down here and expanded the range to the downside. Couple features here today. We're back down below the 10 EMA. We've got a pretty important level coming up just a little bit lower, about 1535 is where the 50 DMA resides. We have not yet interacted with that so far this year. So if we do get into that area, that'll be the first key area. Once that gets lost, if in fact it is lost, the next level is going to be 1500, which is 4/8 on the GAN box. Keep in mind the 8/8, the 4/8, and the 0/8 are the most potent levels. And this 4/8 level of 1500 is going to be especially important because it is also the active static trend line from the seeker count here to the upside of our 1 through 9 setup phase. So we've got the static trend line lined up with the 4/8 level on the Murray Math box, and that's going to be a very important level if we do continue to the downside. Now keep in mind that looking at the CCI, we are approaching a pretty oversold level here in the very, very short term, but remember markets that are short term oversold can always get more oversold. And using the CCI as a measurement, you really need to get down to around the 200 to the 250 area before you get that climactic warning, and we're not anywhere near that yet. Alright, now changing the chart to the Nasdaq futures, the NQs, you can see that we had that large expansion of range to the downside. The price action is fairly similar to the S&P side. The only thing is, since the Nasdaq has been relatively less strong than the broad market all year, we're already interacting with the 50 DMA. So the 7/8 level, 2773, is going to be very important tomorrow. We very well could wind up with a measuring day tomorrow where we have just a little bit of back and forth, and then the following day, which is going to be Wednesday, is really going to be critical to see if the lack of bids persists and the bears come out and take this lower. Time will tell, but for now the key area here is 7/8 at 2773. If that gives way, we've got a minor level below at 6/8, 2734. It's a minor GAN level because it's the in-between levels, but the one thing that'll make it a little bit more important is that we're also going to be keying off of this prior low, which lines up with it exactly. So that's the next big level, 2734. All right, now as far as the market internals go, the put-call ratio took a pretty big spike. This is the highest reading of the year so far. This reading exceeded the spike that we had earlier in the year when we did have that 2 weeks where we had that sloppy trading where we dropped the trade. But this is definitely something that's notable. It's a new high water mark on the year. The one thing, however, though, is we're just a little bit short of that truly climactic level at about 1.25. So while we do have a spike here in the put call ratio, it's not that super climactic reading that really implies that a reversal back to the upside is close at hand. I'm taking a look at the 10-day trend, the upper chart here, 1.11. This is the broad market down below, just so you can see how they interact with each other. The broad market is obviously pulling back off a high. Once you start to see that and start to see some selling, you want to go to your 10-day trend to see if you get to that 1.35 threshold. Once you get 1.35 or higher, that's the point where you have enough oversold energy in the market to perhaps turn the market and look for that high probability reversal. We don't have that yet. We're still well below that 1.35 threshold, which leaves a lot of gas in the tank for the bears to the downside before we get that internally oversold condition from the New York trend or the ARMS index. Here's the SOX NDX cross in the weekly time frame. We've been noting that we had this very important breakdown here of support where weakness really started to develop in the semiconductors. We did have this recovery back up into that area, but they've not been able to reclaim that, and right now we're still heading lower. So this is a negative overall for the NDX, and a negative NDX generally means negative things for the broad market as well. And this is one of the key metrics here for the risk on and risk off trade. This is the S&P divided by the TLT, which is the broad market divided by the long bond. What we have here is we had this breakdown and then a retest of the lower boundary of our trend channel. What we found here is something that happened that was very, very classic. We broke down, came back up to the lower boundary of the channel, and found resistance there before rolling back down again. We actually made a new nominal low on this. If we follow through lower than this down below, that's going to be very negative for the broad market, and that's going to be an indication that they're going to continue taking risk off. So this is something that we're going to be tracking the next couple of days here. The other key thing that we've been watching here is the OSX versus the oil futures themselves. This is kind of key for the commodity sector in general. We certainly saw the negative manifestations of that today, but certainly when the oil futures were up here, retesting the prior high here, oil futures are measured here in the blue line on the graph. The OSX was not cooperating and not leading. What you really want to see for a good move is you want to see the oil services, the underlying stocks, actually outperforming and leading the way for the futures to ultimately come on and do what they can do. What happens is when you have the futures leading and the stocks lagging, that's actually a divergence, and a classic technical divergence. When this happened, we were saying that the higher futures prices for oil themselves are suspect and we're probably going to pull back down to the downside. We've done that. The OSX here did get dragged up, but it was lagging the oil futures. Now the oil futures are taking to the downside because we had spotted this non-confirmation and this classic divergence. Always be looking for these divergences. You always want to see the underlying stocks leading. When they're lagging, there's always a cause for concern for the underlying commodity. All right, now here's a look at the cumulative advanced decline lines. This is something that is extremely important, especially when you believe you're at an important inflection point in the market. What you'll often see is you'll actually see the advanced decline lines actually leading price. And when you see the advanced decline lines roll over, you really have to pay attention. And as I've tried to communicate before, that is the one thing in the market, the one standalone that I will not fight. There's certain things, well, this can happen, and then well, you need some supporting evidence to go along with that to really make a case. This is the one indicator that can make its case on its own. It should never be argued with. The one thing we've been focusing on was the Nasdaq side. Now, the Nasdaq has been underperforming the broad market all year. The Nasdaq reached up here, tried to make a run, but could not. Let me scroll this back a little bit, and as you can see, the Nasdaq was not making a new high on this move. This is actually a lower high here on the Nasdaq side. So what you wind up with here, let me just move these a better location. Now what we wound up with was, we actually wound up with a break of this uptrend line at a lower high here. If you recall, the prior high was higher. And this is a real cause for concern because once you have the advanced declines rolling over, you're losing internal strength in the market. This roll to the downside, has very negative implications for the market overall. The Nasdaq side generally leads the broad market side. Now, if you turn your attention to the top chart here, which is the broad market side, we're actually right down to this trend line. The S&P side of the market has had relative strength all year, and so far it's been holding up. But right now we're at a very key area. If we break this trend line to the downside here and follow through, that's probably going to be the death knell for this run in the market. That's we're into this 4 years now. So we really want to focus on this and make sure we're tracking this every day to see how the internal health goes. As far as the market internals go today, I mean they were just dreadful. We were minus 2,300 issues on the New York side, and minus about 2,000 issues on the Nasdaq side. So you can see that both lines took big hits. The Nasdaq side has broken and confirmed that, but we just have to see if the New York side will roll down and ultimately produce that sell signal, which hasn't happened yet, but could very easily do so. Here's a look at the individual sectors ranked from best on the day to worst. And you know it's a bad day when nothing's green. Obviously, the defensive names were at the top of the list here: the pharmaceuticals, the utilities, and whatnot. Of course, with what was happening with the commodities, gold and silver was a very poor performer. The housing sector was also very hard hit, down about 6%. This is notable because there's been a couple of days of bad data, and that's definitely starting to release itself to the downside here. Oil and in the service sector was very, very weak. The OSX, transports were weak, the oils were weak. So you can really see here that it definitely commodity related, and certainly there was a risk off across the board here. So let's take a look at how some of these charts look. All right, so here's an important chart. This is the BTK index. BTK was going for 12 days up as of last week, which completed. Today would have been 13 days up, but the decline was so severe they never got to print that. The takeaway that's important here is that if we do have another strong day, we're going to wind up printing the 13 exhaustion on this seeker run, and we'll probably wind up putting this 4/8 level and this 50 DMA at 1750 in play. All right, here's a look at the OSX. OSX did print that 13 exhaustion warning up in here. So now that that was completed, we're looking for downside, and certainly that signal was right on time. We had this just absolute crushing day. This is definitely the most negative day of the year for the OSX. We've spanned all the way down to this 5/8 level, which also fills this open gap. Very, very key technical development that gap has now been filled. With this range expansion to the downside, unless there's many more margin calls tomorrow, we'll probably wind up with some kind of a measuring day just to work off this this explosive move to the downside. If we do continue to the downside, the level to watch is going to be 4/8 here on the chart, which is this that midpoint of the Murray math box, and definitely a point of interest. That's 434.5. If we get down there, that's definitely going to be a key area to watch, and probably going to find support if we get down to that area, at least for the near term. Note that if we do close down in that area, that will be a new low close on the move, and also that this 13 exhaustion is basically a retest of the prior high and also a lower high. So effectively that would be kicking in to the downside. If it does materialize, that'll be kicking in the C wave to the downside, which is where you can really dig your heels in on the short side. The SOX, or the semiconductor index, still has a 13 exhaustion warning in place to the downside, so that sell signal is starting to bear down on things here a little bit. We're now down below two of our key moving averages. We're back down below the 10 and the 50, which have been fairly lateral. Key point of reference here is going to be about 414, which was this prior swing low. If that gets taken out, 4/8 level will come into play at 406.25, and then all the way down to the 200 DMA here, which is the green line on our chart. All right, so on to the XAU, which is probably the most interesting chart of the day. Here's the XAU. This is the daily time frame. We're now down below 0/8 into the oversold territory. We actually lost the -2/8 level. In so doing, we're actually going to wind up frame shifting to the downside, which is never a positive development. We had this 9-bar run on the seeker count to the downside, and we had this subsequent 9-bar run to the downside. But we have not yet gotten anywhere near an exhaustion warning to the downside. We're only 3 bars down right now in the exhaustion count for the countdown phase of the seeker. So there's another 10 candles to the downside potentially before we're going to get any help from the exhaustion setup from the seeker. So there's plenty of potential to the downside. The only word of caution and looking for more downside here though is just looking at how very oversold we are here on the weekly. We're now working on 12 weeks down on the weekly, and if that does wind up setting up, I would definitely keep an eye on the weekly time frame here, because we have been down here for quite a nice trend, and now we're accelerating to the downside. So we're going to keep an eye on this on the weekly time frame to see if we can get that seeker set up for the exhaustion warning on the weekly chart. All right, here's a look at the gold futures. The gold futures will frame shift tomorrow. On the open, we've closed well below -3/8. Obviously, we're extremely short-term oversold, but as we always say, that oversold markets can always get more oversold. The CCI, if you can look at my cursor here, is -420. When you get to minus about 200, -250, that's when you are technically oversold by the CCI measurement, the commodity channel indicator. So this is definitely just an absolute wrecking here to the downside. Usually you find buyers after 3 days down. This is 2 days down now of pretty acute selling. So definitely keep an eye on this for some kind of a measuring day tomorrow. There obviously was a lot of selling all day today. There was a second wave of margin selling after the midday base. So certainly there's going to be some bargain hunters looking for this, and it's just a question of can they actually turn the trend or not. All right, folks, that's going to be it for this evening. As always, thanks for listening. And this is Rich from Tradesight.